Okay, let's go ahead and go on to Chapter 8. Chapter 8 is about long-term assets, and the thing that we want to make sure that you understand here is that the word capitalizing means setting up as an asset. So why would we capitalize something as an asset? Because it has long-term value. Remember, if something is going to last less than a year, then we're going to expense it. If something lasts more than a year, then we're going to capitalize it. And how do we adjust that from capitalizing an asset over to the expense as the asset begins to wear out? Well, it depends on what type of asset it is based on the terminology. So if it's a tangible asset, if it's a building or equipment, something that has physical property, we call that depreciation. If it's an intangible asset, there's examples in the study guide. A patent or copyright or goodwill, you can read about those in the book. If it's an intangible asset that has no physical property, then we call that amortization. And then if it's a natural resource, we call that depletion. So oil and gas, we would set it up and then move it to an expense by process of depletion. Now the entries are all the same, it's just different account names. Let's make sure we understand what's going on with the process of capitalizing and depreciating long-term assets. So here's the dry erase board I got set up on January 1st. We're buying equipment for $24,000. We credit cash for $24,000. What is the income statement effect of this entry? Think about that for a second. Well, the answer is nothing, because equipment is an asset, cash is an asset. There's nothing that occurs on the equity side of the transaction or on the income statement. So we just basically swap assets here, and then as this equipment begins to be used up, that's when we need to take it to depreciation. Now we're going to make an adjusting entry every period for this equipment to show that the value of the equipment is going down. Now we're going to use a contra asset just like we did in Chapter 7 for accounts receivable. So we'll have equipment, we'll set that up for $24,000, that'll have a debit, and we'll have accumulated depreciation. That's the name of this other account here, and it's going to have a debit or credit. Well, if it's contra asset, it's going to have a credit right there. Okay, and again, just like on the account receivable, these are going to be shown at a net number on the balance sheet. So how does this work? Well, every period we're going to put some in there as a credit for accumulated depreciation. The opposite side of the entry, we'll see here in a second, is depreciation expense. So let's go ahead and just show this entry. So at the end of the year or end of the quarter or month or whatever we're doing, we would show depreciation expense. We'll have an amount there. The credit is going to go to accumulated depreciation right there. That's going to be our entry. So this would be going to the income statement. This will be reducing the amount of the net equipment on the balance sheet. So we're going to make this same entry, or the entry might be different amounts, but we're going to make the same entry, debits and credits every adjusting period, which is going to be over here adding up in accumulated depreciation. Accumulated meaning that they added together. So let's say the first period we put in 4 there. Well, what's the value on the balance sheet? It would be 20. The next period we put another 4. What's that balance? 16. Next period we put another 4. That balance goes to 12. So we're writing down the equipment using this account accumulated depreciation to show what we estimate that amount to be if we were to sell it at that time. We don't want it on the books at 24 anymore unless it's a piece of land. Land doesn't typically depreciate. It typically goes up in value actually, but so the equipment, just like a new car, once you drive it off the lot, that's going to go down. You're not going to be able to sell it for the same amount. The equipment, we're going to be writing it down through accumulated depreciation over time. What happens whenever we sell this account? So we'll say like 2020 or whatever it is, we'll say that our accumulated depreciation at that time has a balance of 12. The equipment there is 14. So at 2020, we're going to sell for $15,000. Well, we know we got cash of 15 there. What else do we need to do? We have accumulated depreciation. We need to take these off of the books because we're selling the account and it's not going to be there anymore. So accumulated depreciation had a credit balance of 12. We need to debit that to get that written, to get it out of there. The equipment had a balance of 24. We got it out of there. So are all our accounts cleared out? We got our cash coming in. We got rid of these. Well, if the cash equaled the book value, we call it book value. 24 minus 12 is 12. The book value is the difference between these two. If the cash equaled the book value, then it would be the case. But in this case, we're getting more cash than our book value here. The book value is 12. We got 15 coming in, so our debits are exceeding credits. So in this case, we have a gain. We got more than our book value, so we have 3 of gain. If we had only gotten, say, 10, well, then we would have a loss of 2 because 24 minus 12 is 12. We only got 10. That would be a loss. Okay, I want to spend the rest of the time looking at this entry here. How do we actually record the depreciation expense and accumulated depreciation? So let me clean off the dry erase. Make sure you have your study guide out here as we go through the 4 different methods that we look at for accounting for depreciation. So first one is straight line. Let's go ahead and write these out. We'll do it over here, straight line, and we'll do an amount here. So let's look at straight line. We know our entry is not going to change the debits and credits. So depreciation expense and accumulated depreciation credit. We're going to look at these different estimates are showing us what are these amounts in these different debits and credits. So under the straight line, here's what we do. We look at our book value, the original book value of our asset. It's $24,000. So original. We'll just call that original. Now we subtract what we call salvage value. Sometimes you'll hear that called residual value. In the example I've given you, we have 2,000 salvage value. Okay? So what do we do here? We subtract. We get 22,000. And what we call here, this is our depreciable base. Over the life of the asset, this is the amount of depreciation that we want to record. We don't want to go below our salvage value because what this says is at the end of the life, we think we're going to be able to sell this asset for $2,000. So we want to have exactly this amount on the net value of the asset at the end of the life so that if we sell it, there's neither a gain or a loss. So we're going to take $22,000 in depreciation. So under the straight line method, just think it's a straight line means the same every period. We're just going to divide this depreciable base by the useful life. Okay, 22,000 divided by whatever we determine the useful life is. Now, understand that these are estimates, right? We don't exactly know what the useful life of a computer or equipment is. We don't exactly know what the salvage value is going to be. So there's a lot of estimates in here that 2 good accountants can get to different amounts. So useful life in the example here I said was 5. So under straight line, what is our depreciation entry? 22,000 divided by 5, 4,400. Okay, so this is 2010 depreciation, 4,400 under straight line. Now, let me ask you a question. In 2011, what's that amount going to be? Well, straight line, this is very simple. It's going to be the same amount. So we take that 4,400, the same over every period, 2010, 11, 12, 13, 14, okay? And then at the end of those 5 years, it would be written down to $2,000. Okay, now let's look at the units of production method.